Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me on the show today is a new guest, Justin Huhn, better known as Uranium Insider on Twitter. How are you today, Justin?
Doing really well, Tom. How are you?
I'm great. Justin, could you give us a quick overview on how you got into the sector?
Sure. Yeah. I've been in the markets for about a decade. Started out primarily as a momentum sort of trend following trader. And I got interested in uranium. It was in 2016 from a couple of podcasts. One of them was a Palisade Radio podcast. And being primarily a technical trader up to that point, there was something that really kind of struck a nerve with me with fundamental contrarian investing in this sector that's been beat up for many, many years. And the commodity price is well below the price of production. It all kind of struck a nerve with me and piqued my interest. And I started just looking into it a little bit deeper around that time. It was like late 2016. The story just kind of continued to improve, and I started investing in the space in 2017, just kind of slowly building small positions in the companies that I liked, and have been doing so since then. And the fundamental story just continues to improve. So hopefully we're looking at finally some positive motion in the market now, and it's kind of a short history there.
Absolutely. And that's one of the reasons I wanted to get you on here this week, is because I don't want uranium to get maybe forgotten in place of gold and silver, because it does seem like the fundamentals are shaping up really well here. Could you give us a little explanation on what the long-term price versus the spot price is on uranium?
Sure. Yeah. So the uranium primarily is produced and sold and traded through long-term contracts between producers and utilities, nuclear utilities. The long-term price it's a bit complicated because the published price currently is actually well below what contracts have been signed at over the past year or two. It's currently $31 a pound, the long-term price, but the reasoning for that is that there's a wide range of contracts varying in both size and time of delivery that qualify as long-term contracts. So, for example, if you have an actual contract signed between a producer and a utility for, let's say, $45 a pound for a few million pounds and delivery out for 5 years, that if during that same period of time there is a 2-year contract that an offer is made for even a few 100,000 pounds at $31 a pound, that's the price that gets reported. So it's a little bit tricky. It's potentially a little bit manipulated, but generally speaking, that's really what drives the market for the price and for the contracting cycle of utilities and producers. Investors tend to watch the spot price mainly because it's the thing that's updated on a weekly basis, and from entities like Numerco who have a Twitter page. They update it whenever there's a new bid or a new ask between a spot trade negotiation. They'll publish that. So the spot price is much more visible, and it's generally what investors tend to watch. However, the volumes of pounds actually sold and delivered through the spot market are negligible compared to long-term contracting. And so where we're setting up right now is sort of kind of on the cusp of a new contracting cycle, which the last real big contracting cycle was, 2005 to about 2010-ish, during the previous bull market. And what tends to happen is the utilities start to move, and then they all start to move, and they go through a restocking phase. So after Fukushima and all of Japan's reactors shut off overnight, a handful of reactors shut down in Germany, but the production kept coming. Kazakhstan continued to ramp their production, and all of the producers at the time that Fukushima happened just continued to produce as the price started to decline. And so we had a number of years of oversupply, and the utilities continued to sort of bolster inventories through spot purchases when when Kazakhstan was selling into the spot market, which they're no longer doing. So that's kind of a long-winded explanation, but generally speaking, the nuclear fuel market is driven by term contracting. And these contracts, for example, contracts that Cameco would sign between a nuclear utility and them as a producer are 40% term price and 60% spot referenced. So 40% of the contracted fuel is priced at a fixed rate that's generally higher if it's the farther out into the future. There's a very, very small market right now out past 2025 that's north of $55 a pound. So it's a very different market between the term and the spot market. But we're actually starting to see the spot market move right now. There's been some trader activity. We know Cameco is in there accumulating some pounds with the recent shutdown of Cigar Lake mine. And they obviously have McArthur River mine already offline. So the spot market's been kind of heating up over the past week. Hopefully that's a decent explanation.
Yeah, absolutely. And then where does the separative work unit price or the SWU price fit into that? And maybe you could give us a short explanation on that as well.
Sure. So the SWU price, separative work unit, is essentially it's the cost of enrichment. So uranium is dug out of the ground or mined out of the ground through ISR, in situ recovery, through wells. The raw U3O8 uranium, it's milled, it's extracted, and it's sent off to a conversion facility where they convert it into UF6, uranium hexafluoride. From there, it goes to an enrichment facility where it's spun in centrifuges to separate the two isotopes and isolate the U-235 isotope to make enriched uranium. That's the fissile isotope. And so the cost of enrichment is expressed in SWU. And basically what happens is when there's an abundance of uranium and of UF6, but the demand is low, the enrichers, they just basically keep the centrifuges spinning to continually produce. It's expensive and difficult to shut these things down. So that's part of the problem over the past 10 years or so, is this secondary supply that's coming from what's called underfeeding, which is these enrichers just continuously producing EUP, enriched uranium product, through utilizing their excess capacity due to a lessened demand from the utilities and from contracts. So what you had, the last few rallies in spot price, 2016, 2017, you had SWU continuing to fall. And basically what it means is just demand. It's demand for enriched uranium product. So when there's excess supply, it just goes into the market at a very cheap price. Now, once you reach a certain point of a couple of things, of either demand starting to turn around, which we started to see in August of 2018, SWU bottomed, and it's gone up about 40% since then. You have an increasing demand for that product, but you also have potentially a decreasing tails assays. So you have the depleted tails from the enrichment product that's stored at the facility that's making the enriched uranium, and you can only squeeze so much out of these tails, right? There's a great analogy of squeezing juice from an orange, and that first squeeze you get a lot, and then you continue to push, you get a little bit more. Eventually you have these rinds sitting on the countertop, and you can press them really, really hard and get a couple of drops out. And so the enrichment facilities, the tails assays are basically the percentage of remaining U-235 in these depleted tails had fallen to a certain point where the cost to enrich, or SWU, started to rise. So we have SWU actually rising. It's kind of tapered off for the past few months, but it's risen about 40% off its lows, which is a very, very positive sign.
Could you contrast for us let's say the setup and the fundamental thesis for the uranium price right now that we're setting up versus the 2001 to 2010 bull market, where we had no new exploration for quite a while, the Cold War treaty that expired, and the demand from all the new Chinese plants, versus the mine shutdowns, the other factors that are going in to make this bull market?
Sure. Yeah, it's actually a pretty different market in many ways. When things really started to heat up in the previous bull market, you actually didn't have a structural deficit between the uranium being produced and pulled out of the ground versus what was being consumed on an annual basis. So that didn't actually exist. And you had, big new mines come on. McArthur River had come on recently, and Cigar Lake was set to come on. And then when you had the Cigar Lake floods, that really kind of triggered panic amongst the utilities and started that contracting cycle. You did have the growth, the forward growth from Chinese nuclear that was growing then and continues to grow now, but you didn't actually have a deficit between production and consumption. And so what we have now is we have a structural deficit, about 20 million pounds a year, if you don't count secondary supply from what I mentioned, that underfeeding from enrichment. So we're actually pushing a little bit closer to, let's say, 40 to 50 million if you do include that secondary supply of structural deficit between what's literally mined out of the ground and what's consumed by the world's nuclear power reactors. You also have a growth market in reactors. We're seeing reactors set to close, getting life extensions. We're seeing growth all over the world, most importantly in China. But really, there's a couple dozen countries right now that are building nuclear power plants that are under construction. Before this virus came along, which is probably going to set back some grid connections, we were set to have anywhere from 12 to 15 new large reactors connect to the grid globally this year, which is just huge. And so the setup you have right now is the structural deficit that started last year definitely exists this year and just continues to grow in the next couple of years, is working through that oversupply. And so the mobile inventory globally is a very difficult number to calculate, but we feel that the structural deficit is eating through that mobile inventory, and we're slowly working through that oversupply. And so the setup you have right now is a very, very strong outlook, especially if you look out 2025 and beyond. You have a really big supply deficit. And if you look out into the later part of the decade, we at this point literally don't know where we're going to have the uranium to fuel the reactors. So you have mine closures that are happening, some permanent, some temporary. And then the setup right now is basically you have this really delicate balance. We have a very thin spot market, only a couple of producers that are providing material into that spot market. It's no longer KazAtomProm. They're only selling through term contracts and offtake agreements. So you have a very thin spot market. You have utilities that are sort of sitting on their hands right now because there's a lot of overhanging events this year that are sort of keeping utilities, especially in the US, from really jumping on to that contract cycle. We have the presidential election. We have the Russian suspension agreement, which limits uranium importing to 20% of fuel needed for the United States. That ends December 31st, and we're not really sure which way that's going to go, although generally speaking, we expect that it will be at least reinstated to continue to limit that, and it could be even further limited, less than 20%. And then we have the working group, the Nuclear Fuel Working Group, that is an extension of the Section 232 petition that was filed by UR Energy and Energy Fuels in 2018. That came to fruition last July. Though there were no ruling, the president decided not to rule on the recommendations, but established this working group to look deeper into the issues of the nuclear fuel cycle in the United States. And that is still pending. We have heard, we know that there was a proposal in the budget for the year for 2021 for the United States Department of Energy to spend $150 million buying domestically produced uranium, supposedly out for a number of years, though it has to be voted on annually. That's one piece of it. But we know that there's a litany of recommendations for support for the fuel cycle. Then that has just been put on pause with the whole coronavirus situation. So we have this sort of very complicated, very complex situation that's very fundamentally strong, that's setting up. And now the coronavirus comes along and we're starting to see mine closures. We have Cameco shutting down Cigar Lake mine in Saskatchewan. That's 18 million pounds a year, 1.5 million pounds per month. They said it will be a 4-week closure, and I believe it will be significantly longer than that for a number of reasons, but that's one mine. We have Namibia shutting down Rossing. We have not heard an announcement regarding Husab, but it's assumed that Husab is part of that. It's right next door. So that's significant for production from Rossing and Husab that are now closed in Namibia. And we're all sort of waiting to see what happens with Kazakhstan, with Navoy in Uzbekistan. We've got Somer and Komanak in Niger that are both benefiting Orono at the moment. And we have BHP's Olympic Dam in Australia. And any further production, that's literally what's left producing uranium in the world right now. There's some mines in Russia, but they're not sold into the market for the most part. So we're waiting to see if there's going to be further mine closures, but the mine closures that have happened so far have already started to move the spot market. So it's a very, very interesting time for uranium right now.
As you were mentioning KazAtomProm, they partially went public recently, correct?
And 2018. Mm-hmm.
How has their strategy changed to help provide upward price mobility?
Their strategy has changed drastically. They've really done a good job of sticking to their guns and kind of sticking to their word when it comes to what they're saying they're going to do as far as production. So their strategy now essentially is, they're still the lowest cost producer in the world, and they have a number of JV mines with Uranium One, with Cameco, with Orono, with the Chinese. They have offtake agreements with China, with Russia, with India. So their strategy at this point has not necessarily put pressure to move the price up, but it's removed pressure that kept the price down. So they were a spot market seller for many, many years and literally just flooded the spot market with cheap uranium, a lot of cheap uranium. And that's part of the oversupply that led to the bear market that we're just starting to kind of hopefully see turn around here. So much more responsible. They're responsible to shareholders at this point. They're paying a dividend, and they need higher prices too. And so they have these subsoil use agreements that limit their production on the downside and cap it on the upside. And right now they're basically producing as little as they possibly can underneath within those agreements, which they've extended out through 2021 to maintain the current level of production. We could see some supply interruption from them based on border closures and things like that related to the virus, even if their mines stay up. So kind of expecting, even if they don't close any mines, that we'll probably see some lower production numbers for this year from KazAtomProm. But yeah, it's really been a sea change for them from, let's say, all the way up till going public in 2018 in the way that they're operating, and most importantly, the way that they're selling into the market.
So going forward, when you're looking at different companies to invest in this cycle, what are some good management teams that you're looking at, and how do you go about evaluating those companies?
Good question. I look at a number of things, and it really, all of these parameters, they matter so much more in a bear market and in a market where shares are consolidating or dropping, because you really need to invest in companies that are managing their operations responsibly, managing their money responsibly, and treating shareholders fairly. And there are very few. So I like to look at what management has done in the past, just to get some color on their history and their experience. It's not the entire story, but it plays a part in how I like to frame a story around a company. I like to look at dilution, share count. What is the share count? What was the share count? Go back a few years, see if there's been a reverse split, see how much dilution has taken place over the past few years, and most importantly, where that money has gone. Have they acquired assets? Have they done some exploration that's helped to prove out the resource? Have they built any infrastructure? And then another important metric would be to see what percentage of that money raised, of that dilution, has gone into G&A expenses. So salaries, general administrative, just the ongoing expenses of the company. And particularly like to look at salaries. Obviously, people deserve to be compensated justly, but you can really see if a company's stock price has fallen by 50% over the past year or two, and the salaries are $1 million a year and they've done nothing for shareholders, it's a deal breaker for me. I mean, trade it if you'd like, but it's not something I'd like to give my money to. So those are the primary things I look for with the management team. I like to see a geologist with some history, and I like to see what they've done with previous companies. How have shareholders fared with previous companies? That's kind of what I take into account with management. I like to see a certain amount of public engagement without it being over the top marketing, and so some balance between there. I like to be able to access management, have a phone call, have an email exchange, have my questions answered honestly. Those are all things that any retail shareholder can do. With just reach out to management, ask them the questions that are important to you, and just gauge how they answer those questions. So yeah, there's very few companies out there right now that I really think are truly investable in this space. I would say maybe a half dozen, especially in the junior space. There's a number of other things I look at in the companies, but as far as management goes, that's kind of where I start.
Absolutely. And speaking of geos being important to the company, I know you're a fan of the specific geologist that works for Appia, and I wanted to get your thoughts and possibly give us some context on how they have uranium and a lot of rare earths as well in the company.
For sure. Yeah, James Sykes. He's a great guy and a really passionate and skilled geologist. He discovered the Arrow deposit for NextGen, amongst other large deposits. He was part of the teams that discovered the Rough Rider deposit, and I think he was on Denison's team. He helped develop their 3D modeling. I don't remember if it was Griffin or Phoenix. I think it might have been Griffin. Anyways, after NextGen, in a short hiatus, he met with Tom Drivus, who owns Appia. He's the CEO of Appia, who also owns about half the company. Tom does. And he kind of just approached James and was like, hey, what properties do you want? Which is kind of a cool story. You know, what are you looking at? And James was like, well, Appia already owned the Elliott Lake property, uranium properties, which was in his hometown, James's hometown. It's like 200 million pounds of uranium, but it's pretty low grade. It's pretty deep. It needs a higher price. But, you know, if we have sustained prices in the, let's say, 70s and above, then Elliott Lake all of a sudden comes into play. But they have a number of really, really interesting properties kind of in the northeast of the Athabasca Basin, just outside the basin, really. And the one that they've been working on for the past couple of years is Alsis Lake, and that's a rare earths property. And it looks really promising. It has the potential to be a world-class rare earths deposit. The grades are phenomenal. It's the second highest grade of rare earths on the planet, and it's literally on the surface. It's like turn over a rock with a pickaxe and it's right there, kind of thing. So they've been working on that. They've been doing some drilling. They've been doing some surface exploration. The market cap now, I think, is $8 million US. It's just been hammered, like the entire sector. So they're sort of in between a rock and a hard place with the share price. And I know that James is dying to do some more work on Alsace, which they had planned for the summer. I don't know if the virus is going to impact that or not. I'm hoping not. But they've got 3 or 4 other very interesting uranium properties right around in the same neighborhood. And I know that James is dying to get back out there and do some drilling for uranium. But it's a very interesting story. It's primarily a rare earth story right now, but they kind of have this uranium bonus. If the prices of uranium recover, or when they recover and Appia's share price recovers, I'm sure we'll see some action on the uranium front from Appia.
Justin, could you give us some good resources to understand the fuel cycle?
For sure. I reference very often the World Nuclear Association website. It's almost like a Wikipedia for all things nuclear. And they have very, very good explanations for uranium mining, for uranium conversion, for uranium enrichment. and they have pretty up-to-date numbers on the reactors under construction, on the mining production globally, what's coming from where, what countries are producing. So that's probably the number one as far as just understanding all these different spinning metrics of the fuel cycle. So WNA, the World Nuclear Association, has a really, really excellent website.
And you're very active on Twitter. How about some good resources on Twitter for our listeners?
Good question. Yeah, Twitter's amazing. It's something that I was not active on until probably 2016 or 17, I think. And it's just been an unbelievable blessing. I've made such incredible connections. It's a great tool for networking. And there's some really bright guys on there. Let's see if I can come up with a list off the top of my head. Obviously, John Quakes is great for all things news, pressing news, almost in real time. The Gravedigger is another good one. SNS U308 is excellent. Stian Flage, Stian, is very, very smart in the space. Gosh, I'm gonna miss so many. L2 Capital, Marcelo Lopez is very very bright and really knows the space well. Brandon Monroe from Bannerman Resources is just an absolute gem and a total gift to this space. He also puts out kind of an email newsletter every once in a while with really good information on the sector. I'm missing so many people, but if you follow those half dozen I just mentioned, you'll get connected with everybody else on there.
Absolutely. And your website also has a newsletter and a premium subscription as well, correct?
Yes. Yeah. I've got a free newsletter. There's a sign up window just on the front page, uraniuminsider.com. And then I have a premium newsletter as well. They've got a decent community building up here with that newsletter. It's been just a really awesome experience where I share my current stock picks that I update on an ongoing basis, officially every quarter, but stuff changes constantly. So I keep all my members updated on the companies that are in my stock picks, and then just macro, get really detailed into the macro, especially with breaking news and anything that's tradable.
Excellent, Justin. As we wrap up, do you have any final thoughts that you'd like to share with us?
Yeah, I think just kind of like an overall picture of where I'm seeing things for the short and midterm here. I really think that this is a black swan event, this coronavirus situation with the mine closures. I think right now we're in this place where nuclear utilities and fuel buyers are not really sure how long this is going to last. And they think that maybe this could be sort of a speed bump that we'll get over within a month or two. And I do think that the impact on supply is going to be much greater than people are expecting right now. I think we could potentially see 15 to 20 million or more supply shock to the market, pounds, which would be huge. I'm not expecting a rush to the contracting table right now for utilities just because of the overhang I mentioned before, all of the unknowns. That's more likely to happen 2021. But in the meantime, I wouldn't be surprised to see the spot price north of $35 or $40 by the end of the year. And right now we're at 27. It's starting to tick up. The spot market is thin, and the spot price is what investors watch. So I think things are really going to heat up in the next few months. And especially if we hear of more mine closures or extensions on the closures that have already been enacted. I think it's a great place to invest. And I really think that this is the time. There's been a lot of people saying that for a lot of years. I understand that. But the back end fundamentals of the fuel cycle are there. The spot market is thin. And now we have this catalyst that's starting to get things to move with a contracting cycle just right around the corner. So I'm extremely excited about the space, and I've got my money on the line to go along with that conviction. And hopefully we start to see some more players come into the space soon.
Excellent. We'll have to see how it develops. If anybody has
Definitely.
any questions or comments on today's show, please email me at tom@palisaderadio.com. Justin, thanks for your time today.
Thank you, Tom. It's been a pleasure. Appreciate it.
think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?